I'll call to order the Green Mountain Care Board's hearing of March 12th, 2025. We have two agenda items today, a review of hospital guidance for fiscal year 26, and then we also have hospital fiscal year 24 actuals. Member Merman is in a meeting right now, and he will be a little bit late, but we can commence and he will join when he is back from his meeting. So first, I'll move to approve the March 5th, 2025 board meeting minutes.
Second.
All in favor, say aye.
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 Aye. And the minutes are approved with 4 votes. And next, I'll turn it to our Deputy Director of Health Systems Finances, Matt Sutter, for our fiscal year 24 actuals presentation. And really quick before that, I did just want to publicly thank all the board members and staff for all the work everyone's been doing in the legislature. Many healthcare providers and organizations have been busy working with the legislature trying to get legislation that will help the health system challenges we have. And so I just want to thank the hospitals and really our organization for everything everyone's done the last month, testifying on very short notice, preparing edits, all of that work. So thanks everyone for doing that. And I'll turn it to Matt.
Thank you, Chair Foster. I'm going to start with the actual presentation, if that's all right, and then move to guidance. I think it kind of tees up some of the benchmarks from guidance. 1 second to share my screen. And I'm just checking, can you guys see my notes or just the presentation? Just to double check.
It shows notes, but it says no notes.
Okay, I need to fix this. It's pulling to the wrong screen. Give me 1 moment. That should be better.
That looks good.
So thank you. Today we're gonna discuss some FY24 year-end actuals. I'll start with a system-wide look. We'll start with basically an income statement, then look at some system-wide operating and expense and revenue trends. Then we'll jump to we'll also look at FY25 Q1 financial results in for certain ratios, just kind of get a feel for where we are this year, and then review the individual hospitals after that. And there's quite a bit of material to cover. I think we have about 70 slides, so I will be going fairly quickly through these. Please feel free to interject and if you have any questions at any time. Otherwise, it's an information dump. I apologize. So looking system-wide, here's a kind of condensed income statement for the whole system. And let me preface this by saying we've had some delayed actual reporting, which has made some of the system-wide looks a little bit challenging to put together with missing data points. This is what we had in the system as of last night at 7 p.m. So there could still be some updates. If there are any updates change, we will update them on the website and make those and note any changes we made. But I did just want to let everyone know this is a point in time as of last night. So system-wide, if we look at operating income, we budgeted system-wide, there was about $87 million, almost $88 million in operating income budgeted, which reflected about a 2.2% margin. In reality, the operating income came in a little lower, 54 million system-wide, or 1.3% margin. This is still an improvement over last year we had less than a 1% margin system-wide, and then 22 when we were really in the midst of the pandemic, margin was approaching negative 2% system-wide. So we are seeing some improvements there, but still, as you've heard testimony in the past, 1% operating margin is not enough for hospitals. We haven't looked at it this way before, but I did want to look system-wide at growth in operating revenue and expense. If we look at it across the network, across the system, it's grown by almost 40%. From 2.8 billion in pre-pandemic to just over 4 billion now, which is you can see the line graph, it's a rather large increase. However, the story is a little bit different depending on the hospital. And we mostly see this by comparing the University of Vermont Medical Center against the other hospitals in the system. You can see the expense growth and operating growth is much higher at the medical center than it has been across the rest of the hospitals in the system aggregated. If we take this further, again, this is just looking at dollar amounts, and we look at this in terms of like compounding growth since FY19, the difference is pretty stark, where medical centers operating revenue and expense growth has been approaching the high 9% year over year, or on a compounding basis, whereas the other hospitals in aggregate are under 6. If we take a look at the distribution of payer revenue across the system, and let me probably interpret this table for you, might be a little bit helpful. Each column represents the total NPR for the FPP for that year. So if we're looking at FY24, that 31.3% commercial at UVMMC means that of the whole bucket of net patient revenue in the state, 31.3% of that was commercial and went to UVM. You look across over time, you can see the difference in the relative amount of commercial revenue, the piece of the commercial pie increasing at UVM relative to the other hospitals in the state. I also do want to note for the slide, we are beginning in FY24, we started collecting Medicare Advantage, and the way it rolls up in our system is under commercial revenue. In the past, it appears hospitals were more likely or had been bucketing it under Medicare. So for this analysis, I included in the commercial for consistency's sake over time period analysis. But if we included Medicare Advantage in commercial here, you would see it would appear like a big spike in commercial in FY24.
Matt, could you go back?
Yeah.
Could you go back one? And I haven't been through this material, so just a little slower might help me at least. And then just a clarifying question, if you don't mind. I'm looking at Medicare. You split out UVMMC and then all other. So UVMMC's Medicare grew less than the rest of the system's Medicare.
It's a little tricky to talk about it that way because it's for that year, the percentage of Medicare as a percentage of their total NPR system-wide increased.
Yes, got it. Okay, understood. Thank you.
Here's a waterfall graph just graphing the individual hospitals' operating income for FY24 and considering their contribution basically to that 54 million system-wide income we discussed. You can see the distribution was largely the University of Vermont Medical Center contributing to that. Also, Porter and CDMC were the other two largest contributors, with Rutland coming in close at about a $3 million positive operating income. We'll speak to the individual hospitals more in their section. I just wanted to show you kind of a system-wide look of what their individual contributions are here. Here we can look at their actual NPR versus the budgeted or the budget order NPR. I do want to make a small distinction here between the budget order NPR and if we refer to a budgeted NPR. So what's in the orders is a cap, and then hospitals can go in and then they have to provide an updated approved budget to the Green Mountain Care Board, to our team, that is in line with that cap. But in some cases, hospitals will budget lower than the cap. So we don't want to, for enforcement purposes, when we were comparing actuals to what was budgeted, we really want to look at the order rather than what was submitted as their approved budget. So here you can see like across board, you had some hospitals that were within the 1% threshold that we use for enforcement as like the enforcement threshold policy cutoff. But for the most part, we saw some wide variance against what was budgeted. Very quickly, I wanted to just kind of look at, and this might make sense more to come back to it towards the end, but some financial ratios for the hospitals and at the year end. And then I did want to provide a quick update for where we're seeing that at Q1, just to kind of understand where, if they're improving or continuing, if we're seeing some different trends there. We don't have Copley's FY25 figures in yet, so that's why those are missing. And then also on this, there's a lot of numbers here, but on this sheet, I did want to draw folks' attention to the Brattleboro number, 6.5 for FY24. I haven't confirmed yet, but looking at where 25 is, I think this is a function of maybe accidentally booking or designated assets as restricted rather than unrestricted in what was submitted to us. So I need to verify that. I don't put too much faith in that 6.5 day number. And then also included patient days and patients' accounts receivable because we're seeing some relatively high numbers. So,
But Matt, the sorry, go back.
yeah,
The 45 days for Brattleboro, you are comfortable with that number, just not the fiscal year 24 number?
yeah, based on what was submitted in adaptive, yes.
Okay, and then if my, and the minus 13% fiscal year 25 Q1, that number doesn't have noise in it either, to your knowledge?
I would like to double check that because there were some delays in reporting. I want to make sure there's no missing data points, but yes, that's very concerning. I would like to verify it though.
Okay, so there's some verification in some of these numbers that you still would like to do?
Yeah, for the FY25, the Q1 numbers, I would definitely consider these preliminary. And I'll also speak real quickly to operating margin. Not all hospitals, depending on when rates are implemented, sometimes the margin will look there's sort of a seasonality to it, where Q1 might not be entirely representative of what's going to occur for the rest of the year. So there is some nuance there. I did just want to provide some figures to get an idea of where they're at for the year to date.
Okay, and then, sorry, somebody's unmuted. I'm getting a bunch of background noise. Looks like a phone, maybe, 7438. If you could mute 7438, thank you. If my memory serves, there's some nuance in some of the days cash on hand as well, and I want to make sure I remember that and interpret it correctly. So one, I'm going to go through these and tell me if I've got any wrong or I'm missing any. But one, UVM, that's a medical center number. There's also a network and network reserves, which is different, but there's that. Southwestern, if I recall, typically looks artificially low because there's also a parent organization. Am I correct on those two?
Correct.
Okay, and then are there any others with different structures that might make these numbers look different?
Those are the two that jump to mind, specifically the SVMC figure.
Yeah.
Matt, is
Okay.
it possible, sorry, can you just put in parentheses in a future, charts and stuff, just to put the parent for Southwest in there?
Yeah.
And since
Yeah.
this next, I think that would be helpful. Thank you.
Okay.
Hey, Matt, this is Dave. Do you know if Copley's parent holds any days cash on hand?
I don't. I'll need to get back to you on that. It's a good question.
Thanks.
So jumping to the individual hospital profiles, again, we have 14 hospitals and a couple slides for each. So happy to take questions, but we'll go fairly quickly through them. So Brattleboro Memorial, we're seeing against a budgeted operating margin of just under 1%. That was unfavorable, came in at 5% negative operating margin. They did have some non-operating revenue that kind of offsets that a bit. Their total margin was still it's still a loss. Gross patient revenue was nearly flat, offset by higher than expected deductions from revenue in both bad debt and free care. And other operating revenue was highly favorable, so 3.9 million, primarily driven by 340B. Expenses were over budget by about $5 million. This is primarily driven by labor, salaries at 6 million over, traveler overages of 2 million, and we're seeing some pharmaceutical overages as well. And then we also saw favorable other operating revenue of 3.9 million. The overall impact of this, though, is as discussed, a $5.8 million negative operating income. And here are some just financial ratios for BMH over time for comparative purposes. Jumping to the CVMC, they budgeted a negative 1% operating margin. If you recall, historically, CVMC's kind of struggled to make income there. They did have a kind of a turnaround and had 1.7% over a positive operating margin, reflecting 5.4, almost $5.5 million in income for the year. They also had very favorable non-operating revenue, accordingly, a total operating income that was very favorable, over 17 million, almost 18. So the NPR FPP overage of $23.7 million was driven by favorable reimbursement of $3.8 million, $1.3 million from Woodridge's extraordinary funds relief they received from Medicaid. Utilization at $19 million, driven also by utilization at $19 million. There's a higher than expected outpatient and professional volumes, particularly with ER, GI, endo, radiation, oncology, imaging, and lab services. Expenses were over budget by 6%, but less than revenues, obviously. So here the main drivers were fringe benefits, travelers, pharmaceuticals, and, equipment and maintenance. Other operating revenue was also favorable at just under $2 million. So they had a positive operating margin of $5.5 million. And again, here's financial ratios for CVMC. Moving to Copley, an improvement over what was budgeted. They ended up making a margin of 1.4%. It was a positive operating income of almost 1.5 million. They also had a positive non-operating revenue of $2 million, favorable to budget by about 1.8 million. So their total margin was 3.4%, healthy compared to prior years for Copley. Their NPR actually came in slightly under budget by 2.1%, driven by a worsening payer mix and reimbursement, but this was offset by utilization in outpatient and professional services. Their expenses came in 4.7% under budget, also enabling them to make the margin. So they had lower than expected salaries due to being short 48 FTEs vacant. They had this was offset by contract labor, of course, coming in over 5.2 million. And then IT, facility, and drug-related expenses were also slightly over budget. So their operating margin of $1.47 million was favorable. And their financial ratios. Moving to Gifford, we saw a challenging operating margin here of over negative 18%, a loss of $10.6 million. They had some offsetting non-operating revenue, but their total income still negative 9.6%. Major drivers here, largely unfavorable inpatient, slightly unfavorable outpatient, and offset by higher than expected physician fees and S&F. And then expenses were also over budget by 13%, higher than expected labor expenses and other purchase services being the largest drivers there. Other operating revenue was also unfavorable at Gifford, leading to over $10 million operating margin, $10.6 million loss in their operating income. They did have some, as I mentioned, some favorable non-operating revenues. So the total losses came in at $5.6 million, but still unsustainable. And some financial ratios for Gifford.
Matt, can you just go back a slide? Sorry. Do we have a sense of what other purchase services were, that $4 million? Or is it, that's all we know at this point?
I don't, but I'm looking to, I don't know if we had, I'm blanking on whether or not we followed up with them yet about that or not.
Okay.
But we can, yeah, we'll follow up.
That'd be helpful to understand. Thank you.
Grace Cottage, they're kind of unique in that they tend to always budget a negative operating margin. They have very generous donors that kind of fill that gap for them each year. But you'll see their actual results came in worse than budgeted. They were expecting about $1 million loss in operating income. It ended up being about 3 million. They had their non-operating revenue actually came in less than expected as well. So total income was negative in addition to their operating margin. For them, NPR came in over budget at just under $1 million. All major service lines saw overages in gross revenue, but steeper overage in outpatient. This was offset by higher than expected bad debt and free care, however. And then expenses were significantly over budget by almost 9%, driven by higher than expected labor cost and reliance on contract labor. Other operating revenue was also unfavorable, and non-operating revenue was unfavorable due to delayed release of funds for medical office renovation. Moving to Mount Scottney, their operating income came in about at budget at 1.2%. Their budget margin was 1.5%, so around $1 million in income. And their non-operating revenue was more favorable than budget at 6.3 versus 2.5. So their total margin came in at just under 10%, despite the operating margin being relatively low, if not positive. But their NPR FVP was slightly under budget by about 1%. This is under $1 million. Inpatient, outpatient physician services were unfavorable. This was offset by favorable rehab and swing bed, higher than expected ER visits, infusion services down 35%, and favorable bad debt and free care. Expenses were over by 2.1% at $1.5 million due to workforce and staffing issues and contract labor. Other operating revenue was favorable due to third-party settlements and COVID relief funding, so contributing to an overall operating margin of, like I said, just under $1 million. And the non-operating increase relative to budget was favorable due to investment gains. And here are some financial ratios for Mount Scottney. Moving right along North Country, they budgeted basically a break-even budget. They unfortunately didn't quite hit that. They came in operating margins 2.5% negative, about $2.6 million in losses, almost entirely offset by non-operating income. So their total margin came in about break even, but we did see that diminished margin in the operating. So their NPR came under by 2 million. Utilization was over budget, driven by outpatient, offset by lower than expected inpatient professional services. And then they also had unfavorable reimbursements of 16 million because of issues with their billing vendor and EMR system. On the expense side, they were a little bit over budget by about 0.5%, driven by contract staffing and fringe benefits. There was slight offset in depreciation due to deferred capital expenses, CO dues, and other expenses. Other operating income was about on budget, so their operating margin, like you mentioned, was about 2.6 million to the negative, offset not quite entirely, but close by favorable non-operating revenue, 2.5. And here are financial ratios for North Country. Jumping to Northeastern, we saw positive operating margin for them, but essentially break even. They budgeted pretty conservative, just under 1%, reflecting about 1.2 million. They ended up making about a little over 128,000 in operating income, so just over 0.1% positive. They did have very favorable non-operating revenue, however, so their total margin came in just under 5%. NPR slightly over, as mentioned, this is due to overall utilization impact of 0.3%, driven by higher than usual lab and ER services, offset by lower than budgeted inpatient. They did have a $2 million favorable reimbursement payer mix and favorable bad debt free care. Expenses were over budget by 3.6%, driven, sound like a broken record now, but higher labor costs, fringe benefits, physician contracts, contract staffing, drug lab setup, financial services contracts. Other operating income was favorable by 2.2 million due to favorable grant funding, offsetting less than expected 340B revenue. And as mentioned, their non-operating revenue was very favorable to budget due to investment income. Here are some financial ratios for NBRH. Moving along to Northwestern, they budgeted a 1% operating margin of 1.3 million. They unfortunately lost about 3.4 million in operating income, and that equates to about 2.5% negative margin. However, they did have very favorable non-operating revenue and of almost 14 million relative to budget. So their total margin, even though their operating margin was negative 2.5%, their total margin came in near 10%. For Northwestern, their NPR was under budget, driven by overage and bad debt and free care, but gross patient revenue was slightly favorable to budget. Expenses were over budget by 4.3% or $5.6 million, driven again by higher than anticipated labor expenses and reliance on contract labor. As mentioned, other operating revenue was slightly favorable to 340B and grant income, and investment income was very favorable. So their total margins look healthy relative to budget, despite the kind of diminished operating margins. And here's financial ratios for Northwestern. Porter budgeted operating income of 9.5 million or 7.4%. They came in under that at just under 6 million or 4.7%, but still healthy operating margin. Their non-operating revenue was slightly was also improved relative to budget. So the total income ended up being not quite what was budgeted, but within a 1.5%. So Porter's NPR came in under budget by just under $4 million, or 3% lower than expected. This was largely driven by reimbursement or collection rate, coming in significantly lower due to lower reimbursement than expected in Medicaid. Utilization remained nearly flat, lower OR cases offset by outpatient professional volumes. And then expenses were slightly over budget by just under 1%, 1.1 million, driven again by continued reliance on contract labor and losing some staffing. There was also some increased pharmaceutical demand at Porter. Other operating revenue again was $1.3 million to the good. So operating margin came in at about 6 million, and non-operating revenue increased that. Yeah. And here are some financial ratios for Porter. Moving to Rutland. Rutland budgeted $7.9 million in operating income, or 2.3%. They didn't achieve that. But they still had a positive operating margin of just under 1% or 3.2 million. Non-operating revenue was very favorable relative to budget. So their total income was 12.3%. Total margin was 12.3% or 43 million. For Rutland, NPR came in over budget at just under percent, or just under $3 million. Utilization was over by 2.7% due to outpatient revenues, offset by lower than expected inpatient revenue. And they did have higher than anticipated bad debt and free care, kind of offsetting some of that. So on the expense side, they were also over budget by 2.4% or $8.1 million. Major drivers there include labor, expense, drugs, supplies. This was offset by to some degree, by favorable fringe benefits and contract staffing. Again, as mentioned, the non-operating revenue was largely driven by good return on investments. And here are some financial ratios for Rutland. Moving to Southwestern, we saw they budgeted a 1% margin or about $2 million, and they essentially broke even on operating income. So unfavorable to budget, but wasn't a loss. And then non-operating revenue came in below, but somewhat in line with what they were expecting for non-operating revenue. So their total margin, again, less than budgeted, but 4.3%. For SDMC, their NPR was under budget by 1.5 million, or just under percent. Major drivers include increased denials and shift in payer mix. They had less commercial volume. FPP also was slightly under expectations by just under $1 million. Expenses were over budget by 2.6%, or $5.6 million, driven by higher than anticipated physician and fringe benefits, and offset by lower than expected salaries and contract staffing. Drug expenses for 3.5 million. And this was offset also by lower than anticipated depreciation from from project deferrals. Other operating revenue was favorable by $5 million. This came from grant income and 340B, so offsetting the kind of unfavorable NPR and expense results, leading to almost a break-even operating margin. And then non-operating revenue, when you include non-operating revenue, their total income came in at about 9.3 million. And here are financial ratios for SDMC. Jumping to Springfield, they budgeted just under 1% operating margin, or about $500,000. They didn't quite achieve it. They had an operating loss of $45,000, but close to break even there. Their non-operating revenue was favorable compared to what they had budgeted at $633,000. So their total income, that total margin is relatively in line with what they budgeted, of around $500,000. So Springfield's NPR was over budget by 2.3 million, or 3.8%. That increased outpatient professional services offset by lower than anticipated inpatient and unfavorable bad debt free care. Expenses were over budget by 5.1%, or 3.1 million. Major drivers there include higher than anticipated physician salaries and travelers, which is offset by lower than expected other non-salary expense and other consulting services. Other operating revenue was favorable by just under $300,000, so their operating margin came in at, as mentioned, about 45,000 negative. And then total, when you add in non-operating revenues, total margin comes in just under 600,000 for Springfield. And here are financial ratios for them. And last but not least, here's the medical center. So their operating income, they budgeted 64 million. They made just over almost 63 million. So their operating margins were a little bit diminished relative to what they had budgeted, 2.7% compared to 3%. They did make a significant amount of non-operating revenue, 99 million versus 77.4 in their submitted budget. So their total margin came in at 7% compared to the budgeted total margin of 0.8. UVM's NPR was over 2.9% from the order, or 4% from budget of 73 million. Utilization drove 117% of the overage in NPR. Largest share was an outpatient. Commercial contributed about 53% of the overage dollars. Then Medicare at 30.7%. It was offset by $2 million unfavorable impact on collection rate. Better than expected collection from government payers, offset by unfavorable commercial, as well as 26 million unfavorable bad debt, free care, and self-pay offer. They report almost an $11 million unfavorable payer mix. Look at the budget. On the expense side, expenses were over by 6%, or $126 million, due to labor expenses coming in at 4% over 42 million. This includes contract labor and fringe benefits. Other overages include pharmacy, 49 million, med surg supplies at 10, purchase services at 11.7 million, provider tax at 4 million, and other at 12.5. Other operating revenue was also $50.9 million favorable. Overages are due to specialty pharmacy, grant funding, and contract income. In total, their operating income was 62.6 million. And once you add in the non-operating revenue, 81.6 million, you're seeing total margin of about $161 million at the medical center. And here are financial ratios for that.
Hey, Matt, I'm just going to go back
Yes.
2 slides to the UVM NPR overage, 73 million. We might, after a break, need to clarify that. I think there was, if I remember, some distinction between what they submitted in their adaptive submission and what our budget order said. And so that 73 million might be 53, depending on which submission you're looking at.
Yes, that's correct. I should have included the 53 in here after the order parenthetical. Yeah, I touched on that right at the beginning, but they're in some cases where the budget order ends up being the cap, and then they upload their approved budget has to meet that cap. And so in some cases they will lower the budget. And for enforcement purposes, when we're talking about NPR overages, we want to make sure we're looking at the budget order amount.
Right. Thank you.
So next steps after today is to consider hospitals for enforcement. Just as a reminder, we have that 1% NPR threshold, and then additional analyses as requested or asked for. And real quick, I just want to just very quickly go through the enforcement policy. So net patient revenue and fixed prospective payments amounts that's ordered may be enforced. The GMCB may review hospitals whose year-end NPR FPP exceed the requirement by 1% above or below their approved NPR FPP. However, this review will not necessarily lead to action by the GMCB. These budget reviews compare each hospital to results of the total system. Reporting requirements for the review will be determined by the Green Mountain Care Board. Green Mountain Care Board will afford the hospital an opportunity for a hearing and will require hearing if it deems one necessary. And if the GMCB determines that a hospital's performance has differed substantially from its budget, the GMCB may take actions, including but not limited to reducing or increasing the hospital's rates, reducing or increasing net revenue and or expenditure levels in the hospital's budget, use its finding as a consideration to adjust the hospital's budget in one or more subsequent years, allow a hospital to retain a percentage or all of the surplus funds, and any other actions the GMCB deems appropriate. There's also a link to our enforcement policy there. Very quick, we normally provide detailed tables with like 5-year historicals of NPR, OPEX, days cash on hand. Those are going to be moved to a Tableau dashboard that is almost ready for prime time. Not today, though. I am aiming for next week. Get that out there. So the usual things and more that you find in the detailed tables will be there. It's a lot of data maintain and update in a spreadsheet format like this. Ensuring accuracy becomes quite difficult. So we will get that to everyone for the public. I think it's going to be more transparent because we can frankly dive in a little bit deeper with them. But yeah, that's just want to give everyone an update on why those tables are not in this presentation today. And then we also have an appendix at the end with some glossary for common terms used presentations, and then an abbreviation for the hospital. I don't think we did use some abbreviations in there. So if anyone needs a reference here, there at the end of the presentation.
Great. Well, thank you, Matt, for that overview of the 24 actuals. I'll open up to board members for questions and comments, and then I'll take public comment, and then we can move to guidance after that. Any board member questions or comments?
I just have a quick question. When are you expecting to come back with the for decision on the 1%, the people who are 1% over the hospitals?
I don't have a date yet, Robin, but I think that's next on our to-do list.
Okay, great. Thanks.
Yeah.
Just make a quick comment. I mean, I don't think I have a specific question, but thanks, Matt, for putting all this together. I mean, it's really concerning for several of the hospitals. These negative margins are really worrisome. So I think, you know, all of us as a state have a lot of work to do. That's all.
I guess I would just add, I mean, it's obviously really troubling. I think as we look at this, many of these hospitals are frankly keeping the lights on with strong investment gains in 340B. And I think with impending cuts to Medicare and Medicaid that we're seeing on the horizons, potential enhanced subsidies going away, potential inflation due to tariffs and volatility in stock markets, I'm not seeing a bright future here. And I'm just wondering if, you know, hospitals, if we might ask hospitals what they're doing about contingency planning, about sustainability planning. This is something we've asked hospitals for in the past. It might be time to ask hospitals again for what's the plan here. So I guess I'll just throw that out there for conversation.
Matt and your team, thank you for this work. You guys have been exceptional and we really appreciate it. It's the same thing Jess and Tom said, which is it is a difficult picture. And we also have difficult pictures with the non-hospital providers and an extremely difficult position with the insurer, our largest insurer. So there's not a lot of pockets to tap to deal with the financial problems. And there's a lot of financial problems across the system, as we've all been talking about for quite some time. So this is very sobering. And I do flag and worry about those federal changes that could be coming, as we don't have much opportunity to backfill locally, either through our commercial market or in the state budgets. And the stock market's been a bit topsy-turvy lately, and that raises further concern, as that does seem to be something that was quite beneficial to the overall financial picture in 24. I'll turn to the healthcare advocate for any questions or comments.
Sure. I think I'm gonna just sit at a high level and just agree with everyone that the actuals are disturbing, some of them, and the possible federal changes are also very disturbing, both for state government and hospitals and a wide variety. I think if you look at looking back even further, you get these odd blips on some of the adaptive materials of the hospital financials that can't really be explained. I think it's changes in the CFO or accounting practices. And I will note, saying, oh, hospitals use GAAP. Like, GAAP is not a coherent definition, right? I mean, that's like saying, Chair Foster, that we would have the same definition of reasonable, right? That's all it is. It's like a framework that bounds the most unreasonable practice or sets general practices, but within it, you can do what, you exercise discretion. So that's a highlight that even within hospitals, actuals sometimes can't be compared to other actuals because they might be being recorded differently. And we might not know that that's an outlier until well after the fact. I think we should have caution and it's a natural tendency to compare hospitals with each other. But if we admit that the hospitals use GAAP differently, report differently, we don't actually know if what one hospital is saying is X is the same thing that another hospital is saying X. And these are fundamental data issues that limit what we can do in the hospital budget process, and I think really limit our ability to look at the system as a whole. I think also even at kind of mid-level line items like uncompensated care, which would be showing up in Matt's presentation as one aspect of deductions to gross patient care revenue, there's substantial variation in how accurately hospitals can predict bad debt and free care. And it turns out, looking back over the last decade, that some hospitals are really good at accurately predicting it and some aren't. And so I think what's interesting is, there is the notion that it's like, we'd prefer the HCA that, you kind of are either accurately predicting free care or bad debt or providing more free care. But I have a concern that for instance, there's one hospital in particular, and I think I'll reach out to their CFO separately. They consistently underpredict free care but they also overpredict bad debt. And it doesn't equal out. Like their predictions of uncompensated care varies a lot. And it does raise some concerns if you're consistently under predicting free care, like what can we do to make your budget numbers more accurate? Why are you having this variance off? It should be a concern. Although at the same hand, it's like, I love that they're providing a ton of free care, right? I just think their budget should reflect that. So that's all I have to say. And I look forward to, working we have a meeting tomorrow on these budget variance issues and this kind of bigger picture of data consistency and definitional consistency. And I look forward to coming up with a concrete plan to address some of these things. I mean, it's persisted over time, right? These same exact issues existed in 2021 as exists now. So it's really like we've been putting aside this fundamental issue with regulation, but the issue is persisting over time. It hasn't gone away. And I think that's should be a real challenge. And I think, if hospitals on some of them are reporting things to the CMS or to the IRS, there's no reason why we can't think about using them for the Green Mountain Care Board regulation, unless there's a specific reason. Like the numbers should all equal each other roughly, and they don't. So that's our comment. Thank you so much.
Thanks for your comment, Eric. Some of what you mentioned has been discussed in the legislative session this year, and some of it has been subject of budget orders in recent years. How things are budgeted and overs and unders on various line items has been the subject of credibility concerns that are flagged in Care Board budget orders. So it is something that we are keeping an eye on and trying to. It does impact our decisions sometimes, and you see that reflected in some of the orders. Thank you for pointing it out. It is an important thing to look at. We don't want every risk being put on commercial. That's going to be ensuring that commercial markets they have risk with handling those kinds of expenses, and there is assurances and need there. I'll open it to public comment. Mr. Davis?
Mr. Chairman, can you hear me?
Yes, sir. How are you?
I'm fine, thank you.
Good.
I'd like to just say two or three things. I've said them many times, but I think it's now clear that you got to grapple with them sooner or later. I make just a couple of points. One is that what you're doing is trying to manage this whole system as a single system, when in point of fact, the business model of shows that there are really not one Vermont system, but two Vermont systems. One of them is UVM, is the UVM Health Network, okay, which basically has, without formally doing it, is already at capitation, because academic medical centers have to pay their people on a salary basis rather than fee for service. And so the question is, what you've got about 2.4 billion. These numbers are just very rough. You've got over 2 billion for UVM, okay. But then you've got the non-UVM, which is 11 hospitals, and they're in about $1 billion or a little bit less. But those business models are completely different, and you just can't see those. So that's just one point. If you don't look at that, you can't do it. Secondly, I would say is that the original Jessica Holmes' original sustainability strategy, taken as a whole starting in 2019, took into account the fact that that there was not only the money that was spent, it was what the quality was. And and your archives have a huge amount of evidence that the quality that is being delivered at, especially at the UVM Medical Center itself, is dramatically higher than the rest of the other hospitals in the state. The rest of the hospitals, it's not really in many ways their fault. They're and your consultant at Oliver Wyman looked at this very clearly. Most of those small hospitals, independent hospitals in Vermont, are just simply too small to have the kind of medical weight that they can get them away from that can get away from fee for service. They have to do fee for service. They have to do stuff. The small hospitals have to do stuff that they really shouldn't be doing in order to keep the doors open so that they can afford to do what they need to do, which is basically primary care and ER. And so I would just say those two things. If you that's basically, we've been there for 10 years. And nobody that I've heard in the Green Mountain Care Board is willing to talk about stuff like, okay, why is PQI so dramatically bad on quality? And the PQI is supported by different metrics that show, whether admissions from the ER are valid or not. Roughly a third of them aren't. So I just think that we're just not moving. We haven't moved basically at all past where we were in the mid 20s, 20 teens. Okay, and so I just think we're getting nowhere. We have had an all payer model. The all payer model was on the books, aimed at shifting to capitation for the system from 2013 until 2025, and now and so it's over a decade. We got nowhere on capitation at all, and now we're going to go completely. We're going to abandon capitation and go to a head. Okay, and a head is just going to be in another decade. So I just wanted to make those 2 points. Thank you, Mr. Chairman.
No, thank you, and appreciate you being here. I did have a question, if you don't mind. So I do think of the system as two systems. I do. I think of it as a UVM system and the rest of the system. What are you proposing be done differently if I think that?
Then what you simply have to do is for example, if you looked at if you looked at UVMMC's days cash on hand, okay, it went 5 years from 2018 to from starting in 2017. It went 5 years, and it was almost never at investment grade. So the numbers in the recent numbers, the numbers that Matt Sutter just put out about UVMMC, sounds like UVMMC is done pretty well in 2024. And so what will they do in 2025? I don't know. I can tell you, Mr. Chairman, that I am no fan of the leadership quality or the performance of the UVM senior management, which I think is appallingly bad. They're totally unable to talk about the issues. They just don't know how to do it. And so in any event, it's just it's very hard. I sympathize with you. I mean, I think it's the idea when Holmes originally came up with it was great. Okay, let's test every service line, okay, to make sure that there's enough cases so that you can keep up the quality, and B, so that you can enough so that you can so that your unit cost will not be in the stupid area. And it's just never, yeah, Jess, you can see that. It just is that it is very hard. It is very hard to get at that. And and what I can say is, and this is just my view. This is just my view of it. Okay, you're not touch. I don't think you're really getting at it at all. But nobody else is either. The whole rest of the country not getting at it either. The UVM, I mean the Vermont system, crested in the late teens, and if they had carried through the original Holmes's original idea, okay, test those things. If you test those things, if you provide the test that she wanted to do for what you will find is you're going to change in the small hospitals, the non-UVM network hospitals are totally unintegrated, and they're totally unintegrated. There's no way somebody's going to do something in Brattleboro, okay, that has anything to do what they're going to do in St. Albans. I mean, that's just a pipe dream. And so it's extremely hard. And what I would do is, I think the very first thing you can do is look at the system based on per capita. That's how that's how systems need to run, and that's how you need to regulate them. And you have, as I've said before, Mr. Chairman, you've let me say it before, is that what you have is at least 500 pages with 7 different highly credentialed national consultants, okay, who are just saying that the thing doesn't work. So what does PQI show for quality? How much does UVM have enough? Does it have enough days cash on hand to really do the job it's supposed to do? And if I look at all of those things, what I come up with is you don't even touch them. You told me once that you were not afraid of that data in your archives, and I haven't heard a single syllable in all the discussions. That I haven't heard a single discussion about anybody talking about what's happening in the non-UVM network quality. What is happening? Why is UVMMC have such trouble with days cash on hand? And
let me interrupt because you're going a little bit long.
Go ahead.
I'm sorry. I appreciate the response, but I wouldn't mind trying to get particular information. So one, let me challenge you. How many days cash on hand do you think UVM should have?
UVM, it doesn't matter what I think. What matters is what the investment community with S&P 500, Moody's, Fitch, and what they will tell you exactly what they think they have. Okay. And UVMMC has never had it. That's the answer. Okay. Look yourself.
Yeah, it's 147 days cash on hand for the health network. So that's pretty high relative. It's actually a pretty comfortable level. In terms of the quality, number of decisions this last year had quality considerations in the written budget orders. I encourage you to read them. You can read about the quality findings as to UVM and other hospitals. So you should read those. And then in terms of, I think what you're saying is we need to give UVM enough money to operate as well as it can, and that we should make decisions as to some of the smaller hospitals. I think that's what you're getting at. And I agree. It is.
I'm sorry.
I agree
with it.
Executing on member Holmes's ideas is usually a wise track. And we have the Act 167 work and the transformation work that was done for the exact purposes of what you're saying. And so I think we are engaging with it, and we are calling on system-wide transformation because we agree the system does not work. So the reams of data you're talking about, we agree the system's not working. It will not be sustainable. It needs to change. So I think we actually are probably a lot more aligned than maybe you think. But in any event, I'm going to turn to my friend, Mr. Leclerc. Alex, how are you?
Can you hear me okay?
Yes.
Perfect. That was a fascinating meeting last week with the guy from Ohio. I just have a bunch of questions. I was actually on vacation and I really wanted to listen to it, so I did. And a lot of my questions are for UVM in particular. I want to know if they got the fee schedule from that hospital system and put it into their own system and did a comparative analysis to see where the gap is, because that's the goal. Is clearly our commercial payers are supporting UVM more than all the other hospitals based on the data that I just looked at. And I'm assuming there's a huge deficit. My other point would be on commercial insurance payers. So there's the private payers and then there's the public ones. Based on what I see on the UVM fee schedule, they are paying the same amount. If Blue Cross goes bankrupt, then our entire health system fails, including my family's small business and including everyone else's small business. My question is UVM, and I guess the other hospitals too, allowed to charge more for the public insurance companies per unit than the private ones? If the answer is yes, I would encourage them to do so. The reason I'm bringing this up is I had to personally let go one of the insurance companies because they were using a third party to limit our reimbursements. And they said instead of doing an hour treatment, we should do 30 minutes because we get paid the same for 30 minutes or an hour with this third party. I cannot live with that. I said, nope, not going to do it. I'm not going to have my employees see double the amount of patients for their financial benefit. And this third party operates on the behalf of another public company, and they don't care. And that third party is not even willing to go to Medicaid rates, which, to be clear, we lose money on, which is totally fine. I cannot stand what UVM is doing, especially after looking up their PT rates. Again, I'm the PT billing person. With my own exchange Blue Cross plan, my PT eval, which is 15 minutes for that CPT code, is 308. If I have UVM's insurance through the hospital and I get care there, it's 208. And if it's self-pay, it's 196. That to me makes no sense. And I know a lot of the providers out there are doing amazing work. My PCP is amazing. Everyone is amazing that's outside of the hospital. I know the hospital has good employees, but there is a big gap somewhere that we are missing as a public. And it is infuriating as a 30-year-old living at my parents' house because I can't afford health insurance and rent. It's really, really sad. And I cannot wait for golf season because this has been a long winter. Thank you for listening to me. And yeah, I look forward to hearing about what UVM has to say coming up.
Thanks, Alex. I will just echo that the Blue Cross situation, I think, is really acute for them, but then also for all the providers who have limited days cash on hand, right? We just talked about Mr. Davis's comment about UVM having enough. I said UVM's got 145 plus at the network. I am going to guess, I don't know your practice, but I'm going to guess you don't have 145 days cash on hand.
No, we do not have 145 days on cash on hand, and we have a pool that is one of two in the country that needs a new dehumidifier, and that's $100,000. So what we do have in reserves is going right to that. So my big thing is, if Blue Cross goes bankrupt, I want to know what I should tell my employees. Like, hey, are you going to get paid? Because I don't know. That's my concern. And Blue Cross, from what I read in the Free Press article, they have 2/3 of all the plans. So if they go bankrupt, then we are all in big trouble.
The smaller practices, Howard Center, independent practices have very limited days cash on hand, FQHCs. It would be felt there very painfully, very quickly. So thank you for making the point. Ms. Ullman?
Is now the right time for questions from the press?
Sure.
Okay. So Copley's numbers stuck out to me. I understand that y'all believe the situation is grim. Are hospitals actually doing better last year than they had the year before?
Um, so I think it depends on which hospital. I think if you look at compared to what they budgeted, what Mr. Sutter showed was they did worse than what they were planning and budgeted to do. I think some of them did better than last year and some did not. I just got this data in the hearing, so if I'd need to go and double check it and look at it again to accurately answer specifics. But I think that the answer is some are doing quite a bit worse than last year and a few did better.
And I noticed that there was a trend of overspending for staffing. Do we know why?
There's probably nuanced answers to all of that depending on which hospital we're talking about. The general theme might be that there are workforce shortages and challenges, and some of the staffing costs are going up significantly.
And I know that I'm just learning now that you guys are seeing this for the first time. I guess I should have understood that when you were asking questions throughout. But was there a trend of utilization being up and commercial payership being up? Is that an indication of anything?
I'd want to take a look at that information before I answer. I think that we have seen a utilization increase kind of across the state in the last couple of years. I think that is fair to say across payers. And then Mr. Sutter had some data about the commercial increases in total revenue is quite steep and quite serious. And that's part of the challenges that are flowing through to the rest of the system. For example, Mr. Leclerc's practice, if revenue is up on commercial really, really high, it is harder for the commercial payers to give a smaller practice large rate increases. And it also is money coming out of the insurer's pocket in their reserves. And it is also translating to higher insurance premiums.
Okay, last one. And we talked sort of about the boundaries and the reasons for enforcement action and some of the numbers. Will there be any enforcement action taken against any hospitals, if you're able to say, and where and why?
There will certainly be review for enforcement purposes. Whether or not what the outcomes of those are wouldn't be determined. We'd look at all those factors that are in the guidance and we'd get that information and then we'd make some of those decisions. Some of that data we have received. UVM provided us some information on their fiscal year 24 overage. I don't believe we have all of it from everyone yet, but those are decisions we'd make down the road, and the outcomes of them you can't predict.
That's all from me. Thank you for your time.
All right, that was a first for me, Laura. Okay, any other public comment or questions? All right, great. Thank you, Matt. Why don't we take just a 7-minute break to 2:15 and we'll come back and do hospital budget guidance. Okay, it looks like everyone's back. Mr. Sutter, I'll turn it back to you for the guidance presentation.
Great, thank you. Give me 1 minute to get it loaded. All right, pulling the. All right, can I confirm that it's not showing my notes?
Looks good, no notes.
Oh, fantastic. All right, so we have a fairly quick agenda item today, just a recap of some changes, revisions we made to guidance since the last meeting 3 weeks ago. I'll start with a quick introduction and timeline, then I'll recap the benchmarks. We did receive a question about the benchmarks from Boz, so I'd like to answer that here. And then we'll go through some of the revisions to language, supplemental workbook, and then Emma Runya will discuss our peer group methodology, and we'll talk about the change log we have to provide more detail about the changes we've made. So real quick, annually, the board establishes a budget for each hospital by September 15th. The board may establish a process defined on an annual basis, criteria for hospitals to meet, such as utilization and inflation benchmarks. The board may waive one or more of the review processes listed in statute. Established hospital budgets shall meet the requirements of this section, including that they take into consideration national, regional, or in-state peer group norms, according to indicators, ratios, and statistics established by the board. GMCB Rule 300. GMCB will establish benchmarks for any indicators for hospital use in developing and preparing the upcoming fiscal year's budget. Meet with VAS and interested persons to obtain input on benchmarks. Benchmarks are established and provided to hospitals by March 31st. The benchmarks allow the board to determine whether to adjust the hospital's proposed budget. The board can set benchmarks for growth indicators, cost and price indicators, and other financial measures recognized or used in evaluating budgets and or financial plans. So again, just a quick recap. Annually, the board reviews and establishes hospital budgets. These budgets are developed by hospitals in the spring and submitted to the board by July 1st. By the end of March, the board issues guidance to hospitals outlining expected growth benchmarks and the process by which budgets will be considered. A draft of the FY26 hospital budget guidance was presented to the board 3 weeks ago and shared publicly, and public comment was open. The purpose of today's meeting is to present any changes to draft guidance made since that meeting. And in the presentation, this is a link to our hospital budget page where historical materials are available. Here's our timeline for the process. Just some quick upcoming highlights. Starting February 19th, as I said, public comment opened, special comment period that extends until our anticipated vote. Yeah.
Okay, I'm still seeing slide 2. Is that just me, or is it?
I'm so
No, I was, thank you, Dave. I was
I'm
gonna say, Matt, your
so
slides
sorry.
aren't forwarding. Yes, sorry.
Here we go.
There
It was
you
mostly
go.
me reading them, so it's you didn't miss anything. It was just me reading the stuff. So my apologies. Thank you. So yeah, so here our timeline upcoming highlights is starting March until the board votes on guidance. Public comment period is open, and we anticipate voting on that 2 weeks from today on March 26th. So just wanted to provide a quick recap of the benchmarks that we discussed at the last meeting. We are looking for a commercial reimbursement growth of a maximum of 3%, net patient revenue growth of 3.5%, and operating expense growth of 3%. We received a question from Vaz about why CPIU was used as the target for establishing the commercial price growth benchmark as opposed to PCE, which was used last year. We looked at a few measures internally on a staff level where we want to tie this. We looked at the market basket increase in PCE and consumer price index. PCE seems out of alignment with where the market basket increase and consumer price index were landing. For context, PCE for January was about 2.5%, so lower than what we're recommending here. If you look at the underlying numbers, the healthcare component of PCE was actually a decrease. So that's why we kind of landed on CPIU instead of PCE like last year. Boss also asked how we landed on the OpEx benchmark of 3%. So system-wide, if you sort of think of their budgets holistically, system-wide NPR covers on a system-wide look like about 90% of operating expenses, with the rest being covered by other operating revenues. So we just wanted to ensure this benchmark for OpEx is in alignment or like coherent with the NPR growth benchmark that we set using kind of the standard all-pay growth rate. So that's just some additional, we had a request for clarification about how we arrived at these and just wanted to provide them publicly. Staff is also continuing to ask for additional input and public comment on the proposed operating expense benchmark. Obviously, we welcome public comment on the whole process and guidance document in general, but as operating expenses is new for this year, we're asking for additional public comment there. So jumping ahead to revisions to guidance as of today. So a detailed change log is provided at this link here on our website. The document will reflect all the changes made to proposed guidance since the initial draft was presented last month. Most of those changes are just not even technical, just fixes to the document, just fixing language and updating them. They're listed in the change log, but The substantive changes were largely related to the supplemental workbook, but we did make several additions to the Section 2 data sources, including RAND 5.0, which was inadvertently left off the initial list. We also included Vermont Hospital Report Card, Vermont Patient Safety Surveillance and Improvement System Annual Report, DLP Survey and Certification Findings, and VBQHC as data sources. Really quick, I just wanted to run through the sections that we have currently in the supplemental workbook, which will also be available on our website. If it's not now, it will be very shortly. We are asking for additional detail about 340B data, each hospital submitting basic financial information there. We're also asking for additional reporting for network finances for hospitals that generate, or for networks that generate 50% of their total network revenue from Vermont hospitals. We're requiring them submit a supplemental financial workbook. The workbook there's already a draft version in the workbook itself, a draft sheet, but we're basically just asking for a balance sheet, income statement, change in net assets and cash flows, consolidating to the network level. The only individual hospitals that you would need to report in that sheet, though, are the Vermont ones. Referral and visit lag. This year, we're also asking for hospitals report margin on services, hospitals to submit their top 5 highest margin and lowest margin services. We're asking for, like last year, additional information on clinical productivity. We're asking for hospitals to submit a contingency plan where if they're submitting a budget that does not comply with the benchmarks established in guidance, that they outline provide a comparison of gross revenue by department and service area, comparing that compliant budget with what they've submitted. We're asking for additional detail on labor expenses, a detailed breakout with a distinction between clinical and non-clinical staff, a summary of case mix, with a few years of historical and budgeted case mix indexed by payer. We're asking for a list of a table detailing regional collaborations, including partner organizations, with a description and a financial impact. And then we're asking for a table breaking out cost inflation, distinguishing between growth and price and utilization. And I will pass it to Emma to discuss the peer groups.
Great, thanks, Matt. Good afternoon, everyone. I'm just going to run through very quickly our peer group methodology. I do want to preface all this by saying there's a full methodology document on our website right now. So if you want to get into the specifics, I definitely recommend you look at that because this will be more of a high-level overview. For FY26, we've decided to undergo a review of this and create a new methodology and peer group system that better aligns with what our goals are as a board, as a whole for our staff. We started basically by just reviewing what we had already done in the past. The HCA also was really helpful in this. They're developing their own peer group for, for their own purposes, but they were kind enough to share their methodology with us. So we were able to look at that as well. The first kind of main change that I want to just touch on is the fact that you'll see here we have academic medical centers as our first peer group, but we only have 3 total. So there's the academic medical centers, the critical access hospitals, and then we have mid-sized community hospitals. In the past, we've split that mid-sized community hospitals into 2. We're keeping it as 1 for now. 1, it's consistent with the HCA, and 2, we didn't feel like there was a strong enough line to kind of divide that group. It's something that we can continue to refine and work on further if we get more feedback and we find out, or if hospitals begin to kind of diverge and there's a clear separation of groups, something we're happy to take up later. But for the time being, we're going to keep it as these 3 groups. Overall, our data comes from the American Hospital Directory, which is primarily based on cost report data. A little bit of our data also did come from NASHP just for payer mix information, but primarily we used AHD. So looking first at the academic medical centers, the HCA kindly pointed out to us, and we soon found out that there's no formal definition of an academic medical center. So that was our first kind of obstacle. We wanted to define that generally. So we used the AAMC's website. They have a member directory, and we included that. And that gave us 485 entities. I say entities because it also includes systems. So basically step 1 was removing systems from that, because of course we don't want to compare UVM to a system. Then following that, we just applied a series of elimination criteria. So this included kind of generally at the beginning things like missing data, specialty hospitals, does it make sense for us to compare it to a children's hospital? just being in a network also, again, we really want this to be aligned with the Vermont hospitals. And so since UVM is part of a network, we wanted to make sure that all the hospitals in this peer group were part of a network as well. So that was one of our criteria, and there was additional as well in that. So things like being in the same general geographic area. So that removed something like Mayo Clinic that's got hospitals all over the US, as well as making sure that there was only one academic medical center within that network. We then get more specific. So you're looking at things like being urban, not being a rural referral center, not participating in 340B. All of those would be criteria for exclusion. And then we get even more specific kind of as our last step of looking at gross patient revenue, patient days, staffed beds, as well as payer mix. And so when we applied all of those, and again, all the specifics are in that document, we get to these 9 hospitals, including the University of Vermont Medical Center. So in looking at our mid-sized community hospitals, same general process here. The only difference is that looking at all mid-sized community hospitals across the country would be way too much. So we focused immediately on just the Northeast. So we included Maine, Massachusetts, New Hampshire, Vermont, New York, New Jersey, Connecticut, Rhode Island, and Pennsylvania. So collecting all of those, excluding critical access hospitals, we got to 589. That did include academic medical centers though, so we first had to remove those. And then again, very similar process. We're removing for specialty hospitals, data being unavailable, then getting more specific into making sure it's a nonprofit, making sure it's not urban, and then even more specific into staffed beds, 340B, gross patient revenue, and payer mix as well. So at the end of all of that, we get down to this list of 20, including Vermont. I do want to make one note here. You'll see the Champlain Valley Physicians Hospital has a star next to it. That's because technically they were removed during our process. They were eliminated for one or multiple reasons, but we put them back in as they are a member of the University of Vermont Health Network, and we felt like it was important to be able to still look at them as a whole, comparing them to the network hospitals as well as the Vermont hospitals. So that's why there's that star there. Then finally, for critical access hospitals, again, the only real difference here is just the way we got this list. Flex monitoring team monitors the critical access hospitals across the United States. So we use them, and again, use that same set of Northeast states to kind of start with an initial list, and this gave us 79 critical access hospitals. Looking at AHD, we made sure that they did in fact have that critical access designation. We removed it for similar reasons, being no data available, being not a nonprofit, not urban, things like that. Specifically for the critical access as well, when we were looking at payer mix, some data for those were missing for Medicaid specifically, and so those were removed as well. But then it's the same set of principles, looking at whether or not they participated in 340B, looking at their payer mix, their discharges, and their patient days. So this gets us to 33 total hospitals. Again, you can see Alice Hyde Medical Center has a star as well. They were initially removed, but were added back in as they're part of the UVM Health Network. And I'll pass back to Matt.
Great, thanks, Emma. Yeah, so that's it for today's presentation. Today we'll have the guidance document, supplemental workbook, change log. It should also mention the peer group methodology document. These will all be posted on the website for review today. There is, as mentioned, ongoing public comment. I encourage everyone to submit comments to us. Again, we're asking for additional input on the OpEx benchmark if people have comments there. In anticipation of a staff vote, or a staff presenting final revised guidance, in anticipation of a vote on March 26th.
Great. Thank you, Matt. Thank you, Emma. Board member comments or questions?
I could jump in with just a couple. Matt, could you remind me how you came to the operating expense growth benchmark number?
The 3%.
Yeah.
Yeah. So it's basically, we set the NPR benchmark. I want to set the OpEx benchmark so that it's coherent, basically, with that NPR benchmark. And if you look at OpEx, you look at NPR as a percentage of like how much of the total operating expenses that it covers system-wide, it's about 90%. So NPR, without making assumptions about how hospitals can grow other operating revenue, it was kind of I don't want to call it a safe number, but it was a coherent number with the NPR benchmark.
Okay.
it kind of aligns with the NPR benchmark.
Great. The other question I had for you was looking at all these various other reporting duties in the supplemental workbook. Do you think there is any opportunity to give some relief to smaller hospitals to not have to provide all of these reporting requirements, or do you think that these make sense for every hospital within the state to report on?
Potentially, I wouldn't want to commit to anything right now, but I think that's something we can definitely as staff look at and think, come back to the board in between now and the next meeting. If there's any recommendations we have.
Yeah, just see the the relevant impact of, say, we often use these two examples, UVM at one end and Grace at the other. UVM has such a huge impact on healthcare delivery in Vermont, total system expense, insurance premiums. Grace has a big impact in its community, but not outside that area. So trying to think about if there's ways we can streamline our regulatory needs and burden on the entities we regulate. Thanks. And the other thing that I did want to bring up, which is not in the supplemental workbook, but I wonder if it would make sense to put in there, is about salaries. We've talked about executive salaries over the years in different ways. I was wondering if it would make sense to, or what other board members thought about asking hospitals to report their budgeted salaries and maybe their actuals from the prior year, including variable compensation, and what I actually think is almost even maybe more important and impactful is what the variable compensation is based on. I know that the legislature is discussing this for statutory changes, but I wonder if this would make sense to just have in our hospital budget guidance. So maybe something we can talk about and explore between now and the next revision.
Definitely.
I would support talking about that and seeing if there's any opportunity there, merely so that we're ensuring alignment with what we're trying to do as a state. I think having incentives aligned is a positive, and we should see if there's any opportunity there.
This is Tom. I think it's a good idea to discuss further. I'd also be interested, after seeing today's presentation and noticing that more than several of the hospitals were over budget for their operating expenses. And our guidance as written so far this year has operating expenses coherent or aligned with revenue growth. And over the 3 years that I've been reviewing budgets, we've repeatedly noticed that operating expenses were growing very rapidly. And so keeping operating expenses aligned with revenue growth doesn't address the problem of a lack of attention to operating expenses. I think I'd like to be able to think about that with our staff and with the other board members before we finalize guidance.
Can I ask you a question on that?
Yeah.
So are you suggesting that maybe operating expense growth should have a different, and I think you're implying lower rate of growth than revenue growth? Or wanting to potentially explore that concept?
I want to explore it.
Okay.
Any other board member questions or comments? The only comment I would have is if there's opportunity to streamline and reduce administrative burden for some hospitals, and part of that is compliant budgets and submissions timely and accurate and a whole lot of not back and forth. I think it's better for the system, better for the board, better for hospitals. I would like to the extent possible, focus our work and their work where we should and reduce the burden if possible for particular hospitals. Easier said than done, but that is something we should continue to work towards. And we have worked towards in other areas and we have here, but let's continue to think about that and how we can continue to put our effort and time where it's best for the whole system. And hopefully we have a lot of compliant budgets this year and it's a quicker and easier process for everyone. Public comment via raise the hand. Mr. Rooney from the Hospital Association, please go ahead.
Yes, thank you, Chair Foster. Matt and team, thank you for the work. I know the last couple of weeks have probably been quite a mad dash for bringing the guidance to its current state. So just want to express our thanks for that. This is always a very busy month for everyone on the Green Mountain Care Board. I do want to touch on a couple of things here. I'll go with the operating expense growth figure for now. I just want to let everybody know that within operating expenses, there are also expenses associated with other operating revenue that drive that number. So Matt's statement about, NPR covering 90% of expenses, there's a reason for that. So if you're running your cafeteria, that cost is going into your operating expenses, but it's not necessarily being considered in this space because the offsetting revenue is not part of this process. So just want to make everyone aware that there are other operating revenue associated expenses that are dipped into that larger pool of operating expenses. On the commercial reimbursement growth, last year it was pegged to the personal consumption index, and the board was very clear that what it was trying to do was align personal consumption trends with healthcare trends and try to bring those into better alignment. This year it's CPI, and I'm just wondering, why are we changing the indices by which we're looking to peg that 3% to? And then Matt, I'm hoping we can get a meeting here soon. There's a little bit of cleanup in the guidance document. I'm looking at the table of contents. There's some areas within the guidance that are not linked to the table of contents, so it doesn't show. And also the section that's on the filing checklist for cost shift, the net revenue and public reimbursement, that's listed on the filing checklist, but there's not actually a section designated to it in the guidance. And because that's a statutory obligation of the board, I just wanted to call that out. But would love to get a meeting together, talk a little bit more about some of these items and hear some more feedback based on what the board is saying. So my only question right now is the standing change to the indices that we're using to peg the commercial reimbursement growth rate to this year. Thank you.
Yeah, that's a good question. I think the one we're using is higher. Is that right, Matt?
It is, yeah. So what we did is we looked at a few different, we looked at PCE, personal consumption expenditure, we looked at CPI, we looked at what the market basket increase was. PCE is lower. It's 2.5% right now, the January 25 to January 24 figures. Also, if you look at the underlying numbers, healthcare expenditure is down. It's pulling that number down. Not by a ton, but I think, don't hold me to this, but I want to say in aggregate, it was like a $1.7 billion less in the system, like national, like how are that numbers aggregated in healthcare expenditure. So we just, CPI was basically an exact alignment with what the market basket increase was. That's basically how we landed there.
Matt, if I could make sure that I understand, given the choice between using what we used last year and using a variable this year that was more favorable for hospitals, you chose the version that was more favorable for hospitals.
Yes.
And so to build on Member Walsh's point, last year you had that indices plus 1%, which would put it at 3.5% versus your 3% that you've outlined this year. Is that correct?
That's correct. So is the question why we didn't use PCI plus or PCE plus 1%, or is the question why we use CPI instead of PCE?
I think you've answered why you use CPI, because it was more generous across, if you're lining the two up and calling them equal, it's more generous, but there was the additive component last year that was built in, which it sounds like it would be roughly the same as it was last year if you stuck with the PCE, because last year was 3.4, which was with the +1, and this year it'd be 3.5 with the +1.
With the +1, but staff's not recommending the +1 this year.
Okay, thank you.
Great, good questions. Thank you. Any other public comment? Oh, I'm sorry, Mr. Schultz. I usually go to the healthcare advocate first. I'm sorry. Go ahead.
No problem, Chair Foster. So we're gonna submit our comments in writing to the guidance. They're gonna fly at a high level about the method of hospital regulation, not this specific guidance. To the extent we have comments on this particular hospital guidance, I think we can move forward and work with Matt and his team and the team on those. Really, the biggest one is that the inclusion of RAND in that list of resources. I also just wanted to take a moment to note that, it's a substantial improvement to have a rational peer group methodology. And it's not an easy thing, and it should not be overlooked. That I know that looks like a kind of a data nerd thing, but that is not an easy thing to do. And it does mark a drastic improvement, in my opinion, on the comparisons being made. So I think Emma should be congratulated for that. And I look forward to hopefully being in the next few weeks exploring that methodology more together so I understand it fully. Thank you.
Great. Thank you. Any other public comment? Okay. Thank you very much, Emma and Matt and Janelle and the lawyers for the work, and also the hospitals and the HCA for your participation in putting this together and moving along earlier than most years. So great work. Any old business or new business for the board? I will move to adjourn.
Second.
All in favor, say aye.
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 Aye. And we are adjourned. Everyone have a nice day.